Okay, welcome back. So, after seeing the polls in the group, I'd kind of say most of us are beginners. And um, one thing that is going to be very important to the beginner is market structure. So, before premium and discount areas, before liquidity, let me teach market structure. Okay, so one thing you're going to hear most of the time is that the market is in an uptrend or the market is in a downtrend. And in as much as I would not advise you to focus on trends, but as a beginner you need to know what these are. So an uptrending market is a market that keeps making higher prices, and a downtrending market is a market that keeps making lower prices. Okay, so on my charts, for beginner sake, my candles are green and red. So green candles are buy candles, and then technically red candles are also going to be sell candles. Okay, so a buy candle is technically a candle that opens lower and then closes higher than it opened. Opens lower, closes higher than it opened. Opens lower, closes higher than it opened. And let me just take this opportunity to explain the low and then the highs of a candle. Okay, so in a buy candle, it's going to open lower and then close higher. So let's say if it opened at let me just use random raw figures. So let's say if it opened at 1, it's going to close at 3. Okay, and let's say this was a sell candle, so if it opened at 3, it's going to close at 1. Okay, that's why it's red. It closed lower than the opening price, and it's green because it closed higher than the opening price. Okay, so now let me take this again to explain the high and then the low. So in this sense, this price came all the way up here but still managed to close lower. Okay, so the top of this line, which we are going to call wicks. Okay, the top of this line. So now you're learning candle anatomy. Okay, this is the body, this is the wick. Okay, so with the body, it's where price, how should I say, we opened right here. We opened right here, then we came all the way to the low, that is this area, and then this was all the way to the high, and now this is the close. Okay, don't let it confuse you so much. Let me go on to the next candle. So you see right where this candle closed is where the next candle is going to open. Okay, so this candle opened here, we came all the way low into this area, so this is going to be the low of this candle. We came all the way high to around this point, and then now we closed here. Okay, so it's going to be the same thing for the down close candles, which are the sell candles. So let's say this price opened right about here, and then we came all the way low to this area, but then we closed here, still closed lower than opening price. Okay, and then in that time we're able to go high to that point. So if the candle anatomy makes sense, now let's talk about structure. In structure, you're going to hear the terms of an uptrend and then downtrend. So an uptrending market is a market that keeps making higher prices, and then a downtrending market is a market that keeps making lower prices. So in a downtrending market, we're going to have what we call lower highs and then lower lows. Okay, because the market is going to make this high, but in terms of this high that is making, this high is still relatively low to the high that was here. So that's why this high is going to be called a lower high, and then this low is going to be called a lower low. Okay, this high is going to be called a lower high, this low is going to be called a lower low. Okay, so that is for market structure in the downtrend. Let me use the highlighter tool to illustrate a couple of examples. The market is technically just made of highs and lows. Okay, in the progression of this course, you're going to stop looking at the market to trends. Okay, you're going to start understanding why the market is doing what it's doing and what move you're hopping on, whether it's a downtrend or an uptrend. You just place your trades and then you be confident in whatever you're doing. Okay, so on a normal day we had this low in the market. Okay, then we came to create this high at this point. Okay, so now we closed. Okay, so I'm going to be using the technical terms now. So now this candle closed beneath this low. Okay, so now what do we have here? We have a lower low. So now we're going to make a new high. Where are the new highs being made? 1, 2. All these highs are going to be relatively lower than this high. So this is going to be lower highs. Okay, now lower low, lower high, lower low, lower high, lower low, in that order. Okay, so now I'm going to also show you what is called a market structure shift or break of structure, depending on wherever your trading information is coming from. Some people decide to call it a market structure shift, some people decide to call it a break of structure. I'd show you to some extent, and then there's another video, there's another playlist on this channel. It was a playlist I made for like a more advanced group before I actually realized that most are complete beginners, so I had to do like a beginner playlist. Okay, so if you feel like this information is pretty standard to you, you can go on to my technical analysis course playlist, and it's also on the same channel. So you see it, and it has about how many videos so far? I think I've made about 8 or 7 so far. So here we're going to have a low or high, and then we're going to have a lower low. So you see, a whole lot of traders, this is what they are going to call the market structure shift. Okay, because market decided to close above this point, but then in reality we're not there. The market has not decided to shift structure yet. So along this video, probably by video 5, video 6, or in the more advanced section, I'm going to teach you what like a true break of structure is. Okay, so for now, let's just go according to the structure that we know. So this is going to be lower highs and lower lows. We're still in a downtrending market. Okay, so we're creating all these points. And also there are some bits of information, let me just say this, there's some bits of information I'm going to be withholding a bit, because I've already I don't have that much of a large following, I don't have that much of an audience, and I've already seen people copy my stuff. And the big guys in our industry, like they're, how should I say, they're already remaking names to the stuff, and I'd like to be credited. So for now, if I'm not being credited, there are some things that I'm not going to show, like things that I consider a bit advanced to me, you get, because people are literally copying stuff off of the internet, not my stuff per se, but people are literally copying stuff off of the internet, rebranding, repackaging it, and then making like a whole lot out of it. That's my whole reason for making this, because I feel like we are being how should I say it, being exploited. I don't like it when somebody is technically like a newbie, they don't know much about these markets, and then there's someone who's sitting down there just feeling like, oh, because people don't know much about the markets, let me tell them I know much about it and steal their money. I don't know if it makes sense to you guys, but yeah, for me it's kind of not right. So we keep making lower lows in this particular market, then here, and also right here. Okay, so now for those who trade this particular type of market structure, but I want you guys to know it because it's going to be a bit relevant in our like subsequent discussions. For those who trade this particular type of market structure, they are waiting for this point to be broken before they actually say that they have a market structure shift, you get. But in this particular markets, I can a bit safely say that the market structure shift has already happened, and then we're already going for higher prices. Okay, but then for you guys' sake, let me just calm down and then teach what I have to teach. So this is going to be the market structure for a downtrend. Okay, and let's look for a market structure for an uptrend. These are markups I had. Let me delete these. So yeah, as you could see, some of those trades, I think one of them went up, I think about 112 pips. Somewhere I called it in the Telegram channel, but we didn't get all the way up as I was expecting. But then yeah, that's Forex for you, okay? It's not going to be, how should I say it, a rosy ride all the time. Like I said, we also caught that particular sell, but then I left this markup on and I didn't know it was still on. So it's not always going to be like a big rosy ride where all the time you're in profits, or it's going to be like a, how should I say, it's not a one-way street. Okay, there's some days when you're going to lose, there's some days when you're going to win, but the whole aim is to make sure that your wins are more than your losses, and then you're managing your losses very wisely. Me personally, I use like less than a 10 pip stop loss on every trade, regardless of what I'm trading. But for the sake of this class, I'm going to be teaching you guys how to use less than a 30 pip stop loss. Okay, and maybe sometimes you could get like a 10, you could get like a 20, but for now, like your standard, what you should be aiming for is using less than a 30 pip stop loss. Okay, like if you widen your stop losses 50, 100 pips, guys, you are giving your trade room to breathe, but you're also giving your account room to blow. Okay, so for now, you just focus on making yourself a better trader, understanding what the market does. So in this point, let me start by illustrating the downtrend in this market. So okay, so the downtrend in this market, we had consistent lower lows and lower highs being formed, and lower high, lower low, lower high, lower low. Okay, so this was the most recent lower high in the market. So for those who trade with market structure shifts, once this particular high is taken out, this is going to be your market structure shift. You see them right, MSS or slash BOS. Okay, so this is going to be your market structure shift or your break of structure. Okay, then now you'll be anticipating buys to the upside. So with anticipating buys to the upside, I'm going to teach you guys how to use a certain tool called the Fibonacci retracement tool to catch these retracements. Okay, so anytime price is coming back to an area, it's called a retracement. So like, let's say if price was coming back to this low, this is going to be called a retracement. If you're looking at a high point in, let's say, the previous structure, and price was coming back to this high, that's what you're going to call a retracement. Okay, so after this market structure shift or break of structure, now we're going to see, look, now this high has been printed, this lower high has been printed above. Okay, so what caused that was this low. You get it? So now in the new uptrend, this is what we're going to call a lower high, and this is what we're going to call a higher high. So now this high is relatively this low is relatively higher than this one, so this is what we're going to call a higher low. So we're going to have higher lows and higher highs. Okay, my bad, higher lows and higher highs. So now a higher low, these terminologies, now a higher high and a higher low. Okay, let me just be writing them along so that so as we can see here, now we have higher low, we have higher high, we have a higher low. Okay, so we have a higher high here, and then we're going to have a higher low. Okay, so the market decides to finally change structure or change the direction or whatever it is you want to call it. So over here there was a market structure shift in this range. I'm going to teach you guys like all these things later, like if not in this one, I'm going to teach in the advanced course. Okay, for now the only thing I have is a paid signaling and a mentorship, but I'm not going to advise you guys to join now. Like, find your feet in the market, go around, trade, have some fun. Okay, before you first decide that, okay, I've used this guy's stuff, I've tested it, it works. So if maybe there's more you need, or like there's more information you need, then you can hit me up on Telegram for a mentorship, like a private mentorship. That's if you need it. And then if you don't, obviously, or let's say if you can afford it, obviously there's I'm churning out good content, at least that's what I feel, and I'm churning out content on this beginner course and also the advanced course. Okay, I've seen people charge like funny amounts for the course, my technical analysis course. Like that level of knowledge. Okay, I do not want to claim ownership for any knowledge in the forex markets. Okay, so that level of knowledge I've seen people charge like way huge amounts for. So if you're going to be dedicated to the kind of content on this channel, you're going to find like stuff that are going to be way helpful to you there. Okay, if you don't have money to afford like either me or any trader that you feel like, oh, this person could actually mentor me to the best of his abilities and bring out the trader in me, you get. So now that's it for market structure. Okay, so as we're done with market structure, let me go and show you what I call not what I call, what is called the Fibonacci retracement tool. Okay, so with the Fibonacci retracement tool, let's say you are in a downtrend. Okay, in a downtrend, we're going to be looking for retracements at the premium areas. Okay, so like I said, we're going to be doing premium and discount. That's that was for the next part of the video before I cut it. Okay, so we're going to be doing premium and discount areas. So premium is an area where we would like to sell. So for now, just have that in mind that we are going to be selling in a downtrend. Okay, I do not want you to look at the markets in terms of trends, but for the beginner phase, that's what you have to do. Okay, so that you don't get confused. So we're going to be liking to sell the markets in a downtrend and then buy in an uptrend. Okay, there's this beautiful saying in forex that goes like, the trend is your friend. Okay, so for you in your beginning phases, do not try to do anything so complicated. Try and follow the trend. Okay, so I'm going to show you how to use the Fibonacci retracement tool, and I'm going to teach you guys two levels. So I'm going to teach you guys how to use the Fibonacci 61.8, which is going to be the 62, and then the Fibonacci 78.6, which is going to be the 79. Okay, so when you draw the Fibonacci tool, you can click on the tool like this, and then you're going to see this settings thing. Okay, so when you come to settings, these are all the settings I have for my Fibonacci. It's only 4 figures that are on. There's 0, 1, 62, and then 79. I don't use the Fib tool that much anymore because I've gotten to a point where I see most of these things with my eyes. So you also get to that point, like when you use it more than once, not more than once, let me stop kidding. When you use this more than like let's say 50, 100 times, like your eyes are literally going to start picking things up. And then for me personally, I do not look for these points. I look for like specific candles where I sell or buy off. Okay, and also use them in conjunction with time. Okay, so I'm going to show you just like a little, okay, in these examples so that you see how the Fibonacci retracement tool works. So we're going to be drawing our Fibonacci retracement tool from high points to low points when we want to sell, and then we're going to be drawing it from low points to high points when we want to buy. Okay, so this was another high point in these markets that were formed. So let's say we're looking for sales in this particular range. Okay, if we're looking for sales in this particular range, we're going to draw a fib from the high to the low. Okay, and then we're going to anticipate price to come around our premium area for a sell. And then I told you guys, what times are we wanting to enter the market? We're wanting to enter the markets at 1 if it's in Tokyo, 3 when it's in Tokyo. We're looking to enter the market again at 7 when we're in Frankfurt. We're looking to enter the market again at 9 to 9:30 when we're in London, 11 to 11:30, 13 to 13:30 in New York, 14 to 14:30 in New York, and then at 16 hours, okay, New York. So let's just test and see if we've been saying the right things. Okay, so right here at 1, okay, So you could have caught this move if you were looking on structure on the very lower time frames, but you see how this particular push started at 1 to the upside. Okay, so Tokyo opened 1, we started this push all the way to the upside. Okay, so now why did this move again start to the downside? This is going to be 7 o'clock. Okay, so you're seeing how relevant time is in our style of trading. Okay, so at 7, market was at a premium area, excuse me for that. So market was at a premium area, and then we sold that premium area at 7 o'clock. Okay, so now London has opened. Yeah, so I learned that from a couple of South African friends. So London has opened, and we like to take our London trades at 9. Okay, knowing that if we're taking trades here, we'd like to be targeting these areas. So I'll show you in terms of targets also later, like on the course. So look, if we're looking to, where's the next area? 11. Okay, between 11 and 11:30, you can also sell these markets. So now when New York opens 13:30, 13 to 13:30, you see how this move started at 13:30, and then we're going all the way to the upside. We're going to take entries again at 14:30, like we said. So you see how 14:30 we started this push again all the way to this upside. Was Tokyo? What's the next move happening? Okay, at 7. Wait, let me show you guys. So now we've created a new low in the market. Okay, so let's say we're going to look for more sales because structure is still to the downside. So we're going to draw Fibonacci 2 from here to the low. Okay, so with the fib retracement 2, as a beginner, just draw it from the high to the low. Okay, if the wick is really long, if the wicks are that long, still capture wick to wick. Okay, but if you're on a time frame where the bodies are very visible, I'd advise, not all the time, but some of the time, to use the body to body. Okay, because the bodies carry volume. Okay, and that is where you'd want to measure. So let me just retrace on my words and measure body to body of a candle, because I feel like the wick to wick ones are going to confuse you guys a lot. Sometimes there are very long wicks in this market. So measure from the body to body of where the price action stopped. Okay, so this is going to be the highest point on this high, and then this is going to be the lowest body on this low. So now our premium area is going to be between 62 and 79. Okay, so now we're looking to sell the markets at this particular point. We're selling the markets at this particular point. We're going to be waiting for our entry times. Okay, so like let's say here by 7 o'clock. By 7 o'clock, yes, we're in our entry. Okay, so you can sell these markets. If you're going to be placing your stops, I advise you place your stops above the high. Okay, next time I'm going to show you, not next time, subsequently in the course, I'm going to show you like how to cut your stops really tight, but I feel like even this is going to be less than so this is like a 1 to 2.5. For me, I consider this a bit of a less risk to reward ratio, because I usually do like 1 to 7 and above. But then like that's not the point of this course. The point of this crash course is to get you to at least know your stuff. Okay, so you put your stops above this point. Let's say this is a 76 to 30. Technically this is a 30 pip stop loss. Okay, so you're using a 30 pips to target 74 to, yeah, to 30 pips for 70 pips, and I feel like that is okay. Okay, for me that's a bit really low risk to reward ratio, but then this states is going to be a 1 to 2.5, so it's very okay. Okay, for beginner, this this risk to reward is okay. I feel like do not target 1-to-1s, because after a 1-to-1, if you go on to lose the next trade, it means you're back at break even. Okay, so if you have something more like a 1-to-3, at least like on a winning trade, it means you have to take consecutive losses for 3 times before you're back at where you started. So that's going to be this move. So do you get how we draw the fib from a high to a low for sell moves? Obviously you can't reply, so I'm hoping you do. And then there's the Telegram group in case you want to ask any questions. So now let's say we're on the flip side of things. Okay, we've had our market structure shift right here, so it means we're going to be expecting buys. When we're expecting buys, we're going to draw a fib from the low to the high. Okay, so let's capture our body to body. This is where the body ended, so we're going to have our next body. So we'll be looking to sell between the 62 and then the 79. Okay, and then we'll also be combining this with time. So now we're in the New York session. We're looking to take our New York session trades at 14:30. Okay, so where's 14:30? This is 14:30. So 14:30 trades, we take our trade here. Where are we putting our stop loss? We're putting our stop loss underneath this low. Okay, and then what are we going to target? You can target 80 points above the highs, because now we're looking to take out highs in the market. Okay, so let's just say this was the most recent high in this market, so we're taking it out until up until this high. Okay, so that's going to be this is a 1 to 5.97 risk to reward ratio. I feel like this risk to reward ratio is okay. Okay, it really helps. So now we've printed this higher high. Now this was the next higher low in the market. Okay, so where did we print our next higher high? Is over here. We didn't print price high. Okay, so now this was the next higher low that printed this higher high. Okay, so if we're going to be looking for trades, we're going to be marking up this body up until this body. Okay, so now we're looking for trades again within the 62 and then the 79. At what time is this? This is, like I told you, like the times could be off 15 plus or minus 15 minutes. Okay, so by 9:30 what's 9:30? By 9:30, if you were looking to buy, okay, yeah, price tapped your 9:30, so you could have bought at this point. Put your stop losses underneath this area. Let's see, pretty wide. So it's going to be 97 to 78. It's going to be like a 29 pip stop loss. And yeah, I'm teaching you guys to keep your stops under 30 pips, so this is okay. Okay, then let's see when we'll get the next trade. This is 9:30. We're looking for the next trade somewhere around 11:30 if price is in a reasonable zone to buy. Okay, so going off of structure, we're expecting buys. Okay, so there's no way we'd want to start selling at this point. In as much as 11:30 is giving us a sell entry, yeah, we could sell, but know that your structure is overall for buys. Okay, so now this is 13:30. 13:30 gave some buys to the upside, and then 16 was 16 hours. 16 started this reversal. Okay, but then we know how much no structural point has been broken in this area. Okay, so we're still going for higher prices. 19 hours. I haven't taught you guys that. I don't know if I said it in the other time, but for now you guys hold on to the times that you have. Do not complicate yourself with 19 hours for now. So let's go into the next day. Okay, so the next day at 1. So you see how market started to buy at 1. Why? Because we had created this higher low, had created this higher high. Okay, body to body. Okay, 62 retracement level at 1. You take the trade and you delete all the drawings. So at least for now you understand what is going on with the Fibonacci retracement tool. Okay, so courtesy of this video, we understand market structure. That's, even if you don't understand, you can always like write in the group, and then I'm going to answer once I have the time. Okay, I'm a student, but I'm on vacation now, and there are some times where I also like I have stuff to do. Okay, I go around doing other things in town. So if I'm not busy, I'm going to reply to your messages. And since I'm on vacation, it's usually free time, so I'll have time to reply to your messages. So we've done the Fibonacci retracement tool, we've done market structure, and so now we're going to talk about liquidity. Okay, in not so much depth, we're just going to talk about it like lightly, and then in the next video we're going to talk about liquidity proper. Okay, so liquidity is like I said, the willingness of an asset to be bought or sold, and then it's literally going to translate as everything you see on the charts. But then there are some high liquidity points. So high liquidity points are those areas where we'll be looking to target, okay, or we'll be looking for once price has swept the liquidity. In subsequent videos, we're going to be talking about liquidity swipes, liquidity grabs, and then stuff that involve liquidity. Okay, so for now, I'm just going to talk about spotting the liquidity. So anytime we see price making like highs and lows at the same area, okay, something that is going to look like support, do you get? At the same area, price keeps making highs and lows, like at that same area. So like let's say in this area we have this low, and then now we made this low. Let me show you guys on the line chart. So the chart has different representation. You can use bars, you can use Helsinki. I said Helsinki. What's the name? Money highest bars. Okay, so there's the Heikin Ashi candles, there's the hollow candles, there's the lines, the markers, step lines, but the most popular ones are the candles and then the lines. Okay, sometimes I also use the bars, but I feel like bars are very difficult to explain to anyone. In as much as they carry a whole lot of not hidden information, but the information on bars is a bit clear. Okay, because first, that's how the markets used to be represented till the Japanese brought about the candlesticks. Okay, so these are the candles, and so let me show you on the line chart. On the line chart, structure is more visible over there. So we see how we had this area and then we had this area. Okay, these areas look almost on the same how should I say, on the same front. So these are going to be called relatively equal lows. Okay, so those lows are relatively equal. So lows, let me just put a full stop here so at least you understand what I'm talking about. So now let's see, where's the next liquidity point in this market? This high and then this high. Okay, they're going to be relatively equal highs. So like I said, everything you're seeing on the candle stick chart is going to be liquidity, but then we're targeting high liquidity points. Okay, and we're also waiting for a lot of traders to be liquidated. When I say liquidated, I mean their positions are about to be taken out. Okay, if they are in sales, we're waiting for their sales to get blown out so that we in our buys would cash out. Again, if we're in sales, the flip side of things. Okay, so there's this popular beautiful saying again in forex that if you can't spot the liquidity, then you are the liquidity, because all the time there's liquidity in forex markets. So the whole point is you trying to avoid being the liquidity and then taking advantage of what the liquidity is. Okay, so the first type of liquidity I'm teaching you guys is relatively equal lows and relatively equal highs. Okay, once you see that in those markets, just know that no, like something fishy is going on around here. Okay, so look, right here we saw the relatively equal highs, and then if you look below again, you can see these points 1, 2, 3, all of them are literally on the same level. Let me switch to the candles and then we see things properly. Okay, so now we had these relatively equal lows. This liquidity in this market got taken out, so once they got taken out, now price is aiming for the liquidity at the higher parts. Okay, so now we took out this particular liquidity, we took out this one, now we took out this one, we're aiming for higher ones. Okay, if we look properly, this point and this point are also going to be relatively equal highs. What did we do again? We took out those areas, you get. So all market does is going around looking for liquidity points and then taking them out. So now the next point, the next liquidity I'm going to teach you guys is going to be how should I call it? For educational purposes, let's call it trend line liquidity, okay? Because the liquidity is going to be building in the form of a trend. You get, once market keeps making this consistent higher highs and consistent lower lows, it means that all around those points there are traders and institutions that are placing trades, okay? So people are buying at this point, buying at this point, buying at this point, this point, this point, this point, okay? People are selling at this point, selling at this point, selling here, buying here, buying here, buying here, and buying here. So we're going to see all those liquidity points in the market, okay? So I'm just going to denote this by the trend lines, so at least you see what I mean when I'm talking about the liquidity. So we have this, then we have this again, let me hide the sessions so that this will be a bit clear. So then we have this liquidity once again. All this time when market was building this particular trend to the upside, literally liquidity, okay? So once the market is ready to move, the market is going to take out all the liquidity points in the market. So we saw how this liquidity was taking out into this level, okay? So now the market had a market structure shift somewhere in this area, which I'm going to teach like later on, okay? So now when we have a market structure shift, we are going to aim for the lowest points of liquidity in this market, which was around this area, okay? So market is going to take out all that liquidity. And then what were we doing here again? Creating more liquidity, okay? So mind you, I'm always on the 15-minute time frame. For you guys' sake, let me switch to an hour time frame, okay? So now if we look on the hourly time frame, you see how we're forming all this liquidity now. Where is the market heading? To take out all this liquidity, okay? So what the market wants to do is to take out all these liquidity levels, okay? So one thing again you have to know is, you see what I showed you about the candles, okay? The open, low, high, and close. So each candle is going to represent a specific time of data, okay? So for the complete beginners who are new to TradingView, up here we have something called the time frames, okay? So with the time frames, or you can click down here and then you're going to see 1 second, 5 second. The second time frames are for TradingView premium subscribers, okay? It's about 50 something dollars a month or something, if I'm not mistaken. But for now, I wouldn't advise you to purchase it. You can use the basic time frames. You are literally allowed time frames up to 1 minute, okay? And you can customize your time frames. But then I am usually on the 15-minute time frame. Let me put this 30 back on because I'm going to show you guys how to use the 30-minute time frame for entries. So 1 hour is going to represent 1 hour of price data. So we have 17 hours here. The next one, previous one is going to be 16, 15, 14 in that order. If we go to the 4 hour time frames, the time frames are going to be of a difference of 4 hours, okay? If this is 16 and if this is 14, the previous one is going to be 10, 6 in that order, okay? So the next candle is going to open at 14 plus 4, 18 hours, okay? On the 15-minute time frame, it's technically the same thing. 12, 12:15, 12:30, 12:45, okay? 13, 13:15, 13:30, where I taught you guys to enter the markets. 14, 14:15, 14:30, enter the markets, okay? So that's it for what we're talking about in terms of liquidity. We've talked about liquidity. We've talked about 2 types, okay? we're going to go a bit more extensively into liquidity in the subsequent videos. But I feel like today this should be enough information, and I'm also getting tired. So I'll see you guys in the next video. I hope you've learned something, and I'll probably upload those tomorrow when I have the time. So tomorrow we'll be looking to continue with our lectures on liquidity, and then the next topic which I'll post in the group. Okay, so thank you very much for staying up to this long. So in total we have about an hour for today's session. Just take your time. Do not force yourself to understand all these things in one day. Okay, it can be a bit overwhelming, considering the fact that I'm not showing you two horizontal lines and saying the price is bouncing off of support and bouncing off of resistance, and price is going to touch your trend line on the third touch and all those kind of stuff. I feel like those are the basic easy things. But this, in as much as it's also easy, it could be a bit overwhelming if you're not used to this type of trading. Okay. So for now, I'll leave this here, and thank you very much once again for sticking that long into the video to learn for yourself and then to make yourself a better trader. So I'll see you guys in the next video.